Welcome back. Earlier today it was reported U.S. construction spending increased in June, and the prior month's data was also revised higher. Month over month, construction spending overall rose 0.5%. On a year over year basis, it rose 3.5%. Private construction increased 0.5%. Single family housing projects surged 2.1% in June. Here's what the charts look like. The red line is the S&P 500. This is going back to 2015. The blue histogram bars, in this case, this is total construction. And we can see that overall, the spending topped out very close to where the S&P 500 topped out in late 2021, early 22. And there is overall a strong correlation. We're going to talk about the housing market in the next few days and weeks in a number of different aspects. But one of the things that we're really going to talk about is the lack of inventory. And I think that's why, despite high interest rates, there continues to be a lot of spending. And I think you can consider construction spending somewhat of a leading indicator. The more they spend money, obviously they see the demand there. This is non-residential construction, which is very strong. This is one of the highlights of the industry. Non-residential construction is on a year-over-year basis, currently sitting. The latest report, this obviously comparing this July to last July. It was actually June. It's report a month behind, but it's above 15% on a year-over-year basis. This is residential construction, the poor part of our report. You can see that residential construction is in the negative. It's really not what's performing well. And I think this is in part due to the fact that residential buyers are much more sensitive to economic turmoil and interest rates, of course. This is commercial construction, which is surprisingly actually pretty weak these days. Remember, non-residential construction is strong, but that covers a lot of different grounds. And this is commercial construction spending, not so strong. This is highway and street. That is very strong. Now, highway and street is probably more closely related to government spending, and government spending, of course, is not very closely correlated to our economy. The spending goes on regardless of what's happening in the stock market. Here's healthcare spending, which I think is a combination of private and public sector, just because the hospitals and healthcare facilities are so highly subsidized. This is manufacturing construction. Manufacturing sector has been strong, and we can see it's right near the highs that we've seen for a long time here. Manufacturing construction, we're going to see, is actually on a year-over-year basis up like 79%. This is office construction, not so strong. We read a lot about these office buildings in the cities that have been converted into condos, and for good reason. There's just not as much of a demand for office construction. Here's lodging construction, which has come back, but it was hurt the most during the 2020 2021 downturn. We saw numbers upwards of negative 30% growth on a year over year basis. The lodging, obviously, that entire industry was shut down during the COVID crisis. Here's power construction, not really moving, not very strong to the positive side, nor very weak to the negative side. Transportation construction, moderately strong year over year. It's up around 10%. This is overall the different industries that we see here. Now, the ones that really stick out, the top performer, that is manufacturing construction. And we're going to see on a year over year basis, this is upwards of 79%. The red line is residential construction. That is by far the weakest sector. Other areas that were strong and now have sort of subsided, that includes healthcare. Let's see here. Lodging as well. Lodging had a nice recovery, but so far lately it has not been able to pull out, the weeds. Really, the rest of the industry, the construction industry, is more or less at par. The two outliers are residential construction to the downside and manufacturing construction to the upside. Think about this in terms of our own stock portfolios and investments. Think of the investments that we have, or that may be more aligned to either the manufacturing or residential side of the construction industry. Now, this is pretty interesting. What we're going to look at is the actual data here. And we're going to see, for example, when the numbers that we see right now look similar. So, for example, we have a 79.9% increase on a month over month basis. That's from this June to last June in the manufacturing construction industry. I want to go back in time, and this is a tool that we've developed recently that allows us to really go back in time and see when did the numbers look like this, and maybe match that up with periods of time that we know were either very, very strong, over the past, let's say, 5 years up until the COVID crisis, and then very periods of very weak activity, such as 2008 financial recession. So we see here going back the past 6 months, even more than that, the manufacturing construction, it was up January year over year, 68, 69%, 73%, 74%. When did we have 6 months, a period of time that it was so strong? Let's go back in time. We scroll all the way down. Well, we can see this is 2015. 2015 in particular, March through September, we saw on a year-over-year basis increases in construction in the manufacturing construction spending 57%, 53, 57, 51. And then all of a sudden, notice, and this maybe really is the canary in the coal mine. This is actually very interesting. Notice September of 2015, we're at 41% year over year. All of a sudden, that dropped. That was October 2015, 20%. 14%. The next thing you know, January of 16, manufacturing construction was negative on a year over, well, 1.5%. The next month it was negative. So notice how fast things really turn negative in terms of the manufacturing construction. Again, this is where we are now. So if this is any guide, and we know that the stock market was very strong in 2015, if history is any guide, we can maybe use manufacturing construction as again the canary in the coal mine. If this starts to turn negative, maybe we should be very, very careful, to what's to come next. Let's take a look at the outlier, by the way, which is the residential construction. This is over here. It's negative 10% on a year over year basis. Last month, 12, before that, 14, before that, 11, before that, 9. We've had about 5 or 6 months of just very poor results. And before that, if you look at 2022, we saw on a year over year basis 20%, 24, 25. So, and even before that, 34% on a year over year basis. That's June of 21. So, a year ago, 2 years ago, the residential construction was looking very, very good. We know what happened, by the way, over the past couple of years. 11 interest rate hikes. And specifically, last year, June of 22, very interesting. This was the beginning of the inverted bond yield curve right here. Maybe that tells us something, that the inversion of the bond curve really affected residential construction. Well, let's go back in time all the way. Let's pick a period of time that we know residential construction was very strong. Wow, take a look at this. 2003, 20%, 19%, 13% in '04. Continues to be very strong. When did things start to look bad? November of '05, December of '05, 18%, 17%, all of a sudden. By '06, June of '06, we turned negative. And then look how fast. Now we know the stock market really didn't start to crumble until 2008. So about a year and a half before the stock market really started to crumble quickly in the recession of 2008. Remember, we were actually hitting stock market highs late '07. Construction spending, residential wise, was already really crumbling. Take a look at that. Early 2008, this S&P 500 was at all-time highs, and we had residential construction negative 27%. Well, fast forward to where we are now, stock markets right near highs. We have 10%. Now, of course, past performance is not indicative of future results. However, with that said, There's two takeaways we can take from this. First of all, manufacturing construction seems to be very sensitive to economic conditions, but so far it's still very strong. But residential construction, which was very bad in 2007, while the stock market wasn't making new highs, maybe the takeaway from this is that residential construction moves faster than manufacturing. Maybe that private buyers, in the housing markets are much more apt to stay away and not to invest, not to buy new homes, more so than companies that are more hedged and more resilient to economic conditions. It seems that the residential construction may be a leading indicator to the manufacturing industry. Very interesting indeed. So we have later on this week, we have some employment numbers. We have a lot of numbers this week. We're going to do our best to try to talk about as much of them as possible. But so far, construction spending is rising, but be aware, not in all sectors, and that may actually mean something big. We hope this has been helpful. We look forward to seeing you back soon.